Welcome back to The Explainer. Today, we're cutting right through the noise to look at the absolute heartbeat of any business, revenue and expenses. For anyone managing a P&L or analyzing corporate performance, getting the foundational mechanics of these two levers right is literally the difference between thriving and slowly bleeding out. Okay, let's dive into this. To set the stage, let's briefly look back at the foundation we've established in previous discussions. We've covered the three structural pillars of accounting, right? Assets, liabilities, and capital. Think of these as the static architecture of your business. They tell you exactly what you own, what you owe, and the owner's equity at a very specific, frozen moment in time. Now, they are absolutely essential for understanding the overall structure of an entity, but they don't tell the full story of your day-to-day financial engine. So here is the million-dollar question. What actually moves the needle on that cash value? A balance sheet is just a snapshot, but a business is a living, breathing machine. Today, we're stepping away from the static pillars to examine the dynamic, everyday forces, the flowing currents of money that actively shift those foundational numbers day in and day out.
Section 1. What is an expense and the types of expense or expenditure?
At its core, an expense is simply any item or transaction that decreases the business's cash value. Simple enough, right? But as professionals, we know it's not quite that black and white. We have to distinguish between the primary types of expenditure. First up, we have revenue expenditures. These are the day-to-day operating costs of running the business. Think rent, payroll, marketing spend, or SaaS subscriptions. They're consumed immediately just to keep the lights on. Then we have capital expenditures, or CapEx. These are your major investments in long-term assets, like purchasing new server infrastructure, heavy machinery, or acquiring a patent. Now, both revenue and capital expenditures pull cash out of your accounts today, decreasing your immediate cash value, but they impact the business's future financial health in vastly different ways.
Whenever you see a downward trend in cash value, you are looking at an expense in action. Think of a rapidly growing software company burning through cash on aggressive customer acquisition strategies and heavy server infrastructure upgrades. Whether it's an immediate revenue expenditure hitting the P&L this month or a capital expenditure that's going to be depreciated over the next 5 years, the immediate mechanical result is identical. It decreases the overall cash reserves. Recognizing exactly which type of expense is driving that decrease, that is vital for understanding your actual burn rate. And this brilliantly illustrates the momentum shift at play. You start the month flush with cash, but as those operating costs and capital investments hit the ledger, you actively see wealth leaving the business, pulling your baseline down. Recording an expense isn't just some clerical data entry task, it's a direct representation of financial gravity pulling on your reserves. It is the downward force acting on your operational health, and managing the velocity of that drop is the absolute essence of financial strategy. Let's move to and see how this builds into the other half of the equation. Section 2. What is revenue? Revenue is primarily generated from the sale of goods and services, but for an advanced operation, recognizing this revenue goes far beyond just waiting for cash to hit the bank account. Depending on whether you operate on cash or accrual accounting, revenue generation is tied to the exact moment you deliver value to the client. When a consulting firm successfully completes a major retainer project, or a SaaS company delivers its platform to a new enterprise client for the month, that delivery of service is the spark. It's the foundational event that creates a claim to new assets, driving the entire financial machine forward.
Let's lock in the explicit definition. Revenue is any item or transaction which increases the business's cash value. It's the fuel. It is what allows a business to weather the constant drain of its expenditures. While your revenue and capital expenditures are constantly pulling your resources down, your recognized revenue is the powerful engine actively pushing them upward, replenishing the reserves you absolutely need to scale, hire, and innovate.
When we focus on this upward momentum, the mechanic is crystal clear. Increases cash value. Every single time a sales rep closes a deal or a retail location clears inventory, they are injecting positive force into the organization. If we look at a highly successful firm locking in a multi-year annual recurring revenue contract, we are seeing an immediate, undeniable increase in the enterprise's true cash value and operational runway. Now, what's really interesting about this upward momentum is how it compares to our earlier discussion. Here, we start with a lower initial cash reserve, but successful sales act as an immediate upward force, elevating the business's worth in real time. This is literally the visual representation of growth. It shows a business successfully leveraging its expenses, using its payroll and capital investments to generate an even larger, disproportionate return in revenue.
So, the crucial point is that when you strip away the complexities of amortization, depreciation, and complex ledger adjustments, your business health ultimately comes down to mastering these two binary levers. On one side, we have expenses, both capital and revenue expenditures, acting as the force that decreases your cash value. On the flip side, we have revenue, the engine that increases it. Every single strategic decision you make is pushing or pulling on one of these two levers. So, are your revenue engines outperforming your operating costs?
I want to leave you with this final thought. As you review your own operations today, ask yourself, are your daily transactions truly driving upward momentum, or are hidden expenditures quietly draining your foundation? Viewing your operations through this incredibly clear binary lens of revenue and expense helps you cut right through the noise and see the true financial trajectory of your organization. Thanks for joining me on this explainer, and I'll catch you next time.